Okay, so when CPI data came out on Thursday, it was a big shock for everyone, including myself, including Wall Street, including many economists and strategists, because everybody was expecting CPI data to be between 7.2 to 7.3%. The higher was 7.3%. Some were expecting, it's going to be about 7.2%. And I said that if it comes under 7.2, say 7.1, we are going to see a huge market rally that is going to continue. And if it goes over 7.3, I don't even want to talk about it. That's exactly what I said in the video. When the CPI data came out to be 7.5%, I was shocked for at least 5 minutes because I was like, what happened here? Because nobody was expecting that. And the first reaction that I got was that we are going to see a lot more articles talk about recession, a lot more articles talk about a big market crash that's coming up. And that's exactly what I started to notice over this weekend. This video is not about recession because I want to do a full video on recession and what to expect in the coming days. Again, I'm not going to be that one of those channels who's going to say, you know what, the recession is coming for 5 years and it ultimately happens. No, I'm looking at some articles, I'm looking at some data that I'm going to present to you. But in today's video, I want to talk about what CPI data came out and what to expect from the CPI data, and also as we go into the future CPI data releases. So I'm going to share an article with you and we'll go over the article, kind of look over some of the numbers and some of the stats and make sense of what to expect in the coming days. Because at the end of the day, anytime if you go back into the history, and I'm going to share it with chart and everything else, but anytime if you go on the history, anytime we had recession, if you bought those dips, you would be sitting at 5x your money right now. So regardless if we are going to see a recession, regardless we are going to see a market crash, it's very important for investors like you and me. Because remember, you and me, we are not in the market to live in the market. What I mean to say is that we are not making our earnings from the market. If you are, then you probably know a lot more in the market than I do. But I know we all have jobs, we all have businesses, we all have things that we do. And we invest in market to basically make our future more secure. So these kind of times define and actually you can make wealth. I invested in 2008 market crash. I invested heavily during that time without even knowing that this is a market crash that I'm investing in because I was too new in the market at that time. And my investment has led me to about 300% gain in the market. Those investment, if I wouldn't have made it at that time, if I would have made it in a different time, let's say when the market was at all-time high, I would be sitting not at a 300% gain right now. And I'm only able to do it because I was able to invest at the right time. So as investors, it's very important for us to see when to invest in the market and when to take advantage of these so-called recession times or market crash times. Now, if you were to take your money out tomorrow, then absolutely, I feel your pain and I agree with you, this is not a good timing. But if you have, let's say, next 10 years or 5 years to keep your money aside and let it grow, then my friends, we are looking at a golden opportunity at many different levels. So without any delay, I'm going to share my screen and I will actually go ahead and I will give you some details on the recession right here. Okay, so I'm going to, okay, great. So now what you see on your screen is an article of post CPI data and what economists and strategists are talking about it. So I'm going to go over and we'll talk about it over here. So in the beginning it says, January upside CPI surprise adds strongly to the case of 50 basis point hike in March FOMC meeting. So everybody is now talking about that we are going to see a 50 basis point increase on interest rate. That means 0.5% increase in interest rate instead of 0.25% or previously 25 basis point increase. So this CPI data has confirmed one thing, that there are more people favoring to the 50 basis point increase in the March. Will it happen? Will it not happen? Let's read. Okay, the increase was broad-based with energy, food prices, rents keep pricing elevated. Of course, those are the things that kept the CPI data really, really high. Now, in more detail, both headline and core inflation remained at 0.6 month-on-month in January, above our 0.4 estimate. So core inflation also went out 0.2%, which was, of course, that's what made the whole CPI number look at 7.5%. Then monthly inflation is running significantly higher than the implied average of 0.2 that would be consistent with 2% annual inflation or a 0.3% required for 3% annual inflation. Okay, we know that salary increases, that's why we have that 3% increase because it counts for inflation. But inflation right now is running a lot higher. Energy prices were up 0.9% in January, contributing about 1/10 of the monthly increase. Then inflation in core services picked up 0.4% versus 0.3% prior. Housing costs are rising at a robust pace relative to their history. Then bottom line, this surprisingly high CPI reading will likely cause more FOMC members to favor a more aggressive rate hike path. We expect inflation to get worse before it improves, peaking at 7.8% in the next month's report. This is where I think we are going to see a lot more volatile market as we get into as we get into March, towards the CPI data release. Pay attention to this graph, and I've shared the same chart with you guys in my previous video. So the chart now points out that we are going to see a more higher inflation in February. They were already expecting that. They were expecting 7.5% in February to peak before it starts to come down. But now they're saying they're going to see 7.8%. Now the beat that we had this time from 7.3% to 7.5%, as expectation was 7.3%, but it came out 7.5%. I won't be surprised to see a 8% inflation coming into February. Again, nobody knows, but I think what we are seeing here, the prices are not coming down. Then some of the other important point over here is we expect month-over-month CPI inflation in February to accelerate to 0.7% from 0.6% that it's right now, mostly due to a big pop in energy costs and continued inflationary momentum in services categories like shelter. Don't forget, Russia and Ukraine are also having a huge effect on the energy prices or on the gas prices. Okay, beyond February, we expect year-over-year inflation to fall steadily at base effects reverse. However, the pace of the slowdown is now shallower than we expected before today's report. So now they're saying that yes, the inflation is going to come down as we get into 2022, but the rate of inflation, or the rate by which the inflation is coming down, is going to slow down a lot. That's another thing to note. We now expect inflation to fall to 6.5% in second quarter 2022 versus 6% prior. See, it's not just the inflation going up, the rate of inflation going down has also been tamed. That's why they're saying that we were thinking that inflation is going to be 6% in the second quarter of 2022, but now we are talking about 6.5%. That's a huge, huge gap right there. And 4% in the last quarter of the year versus 3.1% consensus. Again, we are only 0.5% difference in the second quarter, but by the time we end the year, it's going to be almost 1%, which is huge and massive number. That's why we are seeing that recession word being taken a lot more now. That forecast is contingent on energy prices falling, with oil dropping from 89 per barrel currently to 80, as the futures curve prescribes. Now, nobody knows what's going to happen with Russia and Ukraine. Now, by the time you're watching this video, there may be some news out, but right now there is no news out. So we can see that they are putting a contingency plan that this only can happen if the energy prices come down and if the price per a barrel of oil comes down to like $80. Still, risk tilt to the upside, and escalation of Russia-Ukraine geopolitical conflict could push oil prices beyond $100 per barrel. This is again very, very uncertain times, and market does not like uncertainty. That's why we are being punished with the high growth stocks that we see. Okay, medical care businesses. Now, this is something if you are into medical or if you are into that sector, because medical sector has been lagging for a while. This is what it says. Medical care services saw a jump in prices in January. Health insurance surged 2.7%. So the health insurance company stocks will do well because they are going to make more money. Even though the category only accounts for 7% weight in the CPI, it has a substantially higher weight in the Fed's preferred price gauge, the PCE deflator, about 17%, the largest weight of any single component, even more than 15% weight for shelter. So medical care services, of course, we need to keep an eye on, especially for the companies as we get into the second quarter. Look at this. Now, the medical care services prices still below pre-pandemic trend. So right here is medical service prices. Pre-pandemic trend would have been around 110 right now. They are still lagging. That means we have more room of growth in this sector right here. Rent increases are accelerating. Gains in both primary residences 0.5% versus 0.4% prior, and owners equivalent rent 0.4 versus 0.4 have more room to run in 2022. So real estate, as per this statement, is going to do better, the rental real estate, as we get into 2022. If you have a rental house, if you're considering a rental house, maybe it's a good time, but again, recession, the uncertainty in the market, nobody can time it, nobody can tell. Okay, now take a look at this. I'm actually going to set, okay. Omicron weighs on hotel pricing, rental car normalization. Again, Omicron, as we know it, is ending very fast overall, but it still has some lagging effect in many parts of the world. And that's why we are seeing a selection of COVID-sensitive categories were mixed in January. Airfare rose 2.3% in seasonally adjusted terms, while lodging cost fell 3.9%, and car rental prices fell 7%. In January, those were the high factors. As we go into February, these factors will elevate. We are seeing that people are now opening up, are traveling, but in January, the fear was really, really high because of Omicron. So they will improve as we get into February, and we will have a better number from these airlines, of course, car rental, hotels will have a better number as we get into February and March. Okay, market reaction. Market participants have thrown open the door to a 50 basis point hike in March. Will the FOMC walk through? Again, for that outcome, moved 50% in the wake of CPI release from about 30% a day prior. So now people are expecting, 50% folks are expecting that the market is going to have, or the Fed is going to release in the FOMC meeting a 50 basis point increase, which is 0.5% interest rate hike. Again, the expectation was 0.25, but they're saying that Fed is going to come out and they will do 0.50 increase. And I also read an article from Goldman Sachs talking about that how the Fed will increase about 7 times this year. Now, there is one common theme that's happening over here. Number one, we know that February CPI data is going to be bad. It's going to be higher. Now, if there is a surprise there where it says it's 7.8%, but it came out to be 8%, then we are absolutely going to see Fed take that effect and basically adjust the rates accordingly. But regardless, till February CPI data comes out in March, we are going to see markets be very volatile. And now I have mentioned this in my previous video, and I'm going to say again in this video, that these are the times when we all have to be very patient. Any green day or any major red day is not going to be last, and it's not going to be the only chance for you to either get out or get in, depending on what you're playing. But I know for a fact that we are going to see a lot more red days, a lot more green days leading up to the FOMC meeting and the rate hike. Because once that's settled, then we at least have a playbook for the rest of the year. Until then, everybody is throwing darts in the dark because we don't know what Fed's going to do. 0.5, 0.25, or 0.75. I even read a report 0.75. I don't think it's going to happen. I think most likely it's going to be 0.25% interest hike, depending on how the CPI data comes out in March. But again, overall, I think we are in for a very, very volatile ride for the next 3 to 4 weeks. I'm sitting on the sidelines. I'm not making any trades. I only trade maybe if I see an opportunity and I get in and get out quickly. I may sell some cash covered puts on my favorite stock because I feel that's the best way to own the stock. And if I ended up owning it, I'm not going to regret it. So that's my plan, and that's how I plan on investing and being in the market for the next few weeks. So I hope I provided some value, and for more one-on-one conversation, consider joining our Patreon and Discord, links in the description below. And if you like this video, then give this video a thumbs up and consider subscribing to our channel. As always, a pleasure to share all of this with you. Until next time, you all have a sparkling day.